Welcome, everybody, to Paving the Way Forward, presented by Wells Fargo and the NFCC, the National Foundation for Credit Counseling. I'm so pleased and honored to be here today. I am your host, Asia, with Urban One. So listen, today we want to welcome you to the series that just helps you learn more about home ownership, right? It's the biggest purchase you'll ever make. Well, for most of us, it's the biggest purchase we'll ever make in life. So we have this amazing show where we break down the barriers to home ownership and we spotlight the paths to kind of make your dream possible. So before you can unlock those doors, when you get those keys and that new little sign that say welcome home, you have to know a couple of things first and foremost. And so we are here today to help you build strong financial foundations, also just kind of give you the knowledge you need to break down those barriers and to answer any questions you may have. So again, I'm so pleased and honored to be your host today. Joining me are my dear, dear friends. They're now my adopted family. So we'll start with Herman with NFCC, again, the National Foundation of Credit Counseling. He is the Senior Vice President of Outreach and Inclusion. So welcome, Herman.
Thank you so much. Glad to be here.
And then we have Rulon Washington. He is the Executive Director of Mortgage Sustainability and Business Execution for Wells Fargo. I believe you're the West Coast or East Coast? East Coast division, right?
East Coast over here.
East Coast. And then Martin. Martin
the other side. Yep.
He's
the left coast.
Yeah. The Executive Director of Mortgage Sustainability for Business and Execution for Wells Fargo. Welcome, Herman, Rulon, and Martin. How you doing, guys?
Hey.
Great.
Glad to
Back
be
for
here.
another
Thank
one.
you so much.
Yeah.
We're back
a little more fun.
People are buying houses. People have questions. And we're here changing lives. How you feel?
Love it.
Awesome.
Love it.
Privilege.
Right. That part.
Privilege. That's the great way of putting it. We're privileged to be in this position to share. So let's get to it. I'm excited today.
Dive right on in. When you think about home ownership and you've never done this before, you are absolutely terrified. Now, you have all these people in your lives telling you all these stories that never bought anything before in their lives, just giving you a whole bunch of bad advice and all kinds of stuff. But let's direct them into point them in the right direction, if you will. So when we look at our debt, because that's where we start first, and we look at the mountains of debt that we have, where would we start when we walk into your office, Herman?
I would say this, and I apologize. This is going to sound self-serving, given that I'm the guy from the National Foundation for Credit Counseling, a HUD-certified intermediary, but I would suggest that you consider professional help. So if your debts feel unmanageable, a reputable credit counseling agency or counselor can help you better understand your particular situation and what options are available to you. They can help you create a personalized budget and help you to use budgeting as an effective tool for managing and taking control of your personal finances. They can help you negotiate with creditors to create win-win scenarios. And this includes a debt management plan if you need that, but from a nonprofit perspective. And what I've just shared for you, the best part is you don't have to take it from little old me. This is what the CFPB, the Center for Consumer Financial Protection Bureau, this is how they recommend starting. So it's not just Ramon saying it, it's the CFPB saying it.
Right. Okay.
Yeah.
So, Rulon, when they walk into your office, what's your advice? How do you get them started?
Well, I would say if to Ramon's point, getting that support early is really important. When you're coming to the bank, you're actually on the latter portions of your journey, right? Because now you are talking about that product, that program, right? And then now those decisions that are made when you need that product or that program, that credit card or that mortgage or that auto loan, now you have to deal with the outcome of the mismanagement of debt, right? So when you think about just managing your bills, your budget, your debt, your credit, sometimes when you are unprepared or when things are mounting or when there's financial pressure, you don't make the best decisions, right? When you're thinking about just a mounting amount of debt, sometimes that anxiety around the financial decisions you make may cause you to hesitate or to not explore resolution, right? So when you think about someone that may be getting into home ownership, let's take someone that's in their mid 20s that may have student loan debt,
Right.
and they had a few credit cards and they have an auto loan, but they also have to pay rent. But their goal is to get into home ownership. That becomes extremely complicated with that mounting amount of debt, right? And
Right.
so when you're ready to have that conversation, do you stick your head in the sand and say, you know what, I'm not ready and I'll never be ready because I have all of this debt? Or do you
Right.
try to search for answers and solutions on how to tackle down some of that debt? Or even having a conversation with your financial institution and saying, hey, my aspirations are this. What can I do to get there? Hopefully, your financial institution will refer you to great organizations like the National Foundation for Credit Counseling, where they can provide a resolution and solution for you. And Herman, it's funny, a lot of folks that don't work with credit counseling agencies, they are unaware that organizations can also help you consolidate credit and debt. They can help you manage debt with creditors. They can help
Oh
you
wow.
pay off, charge off debt, right? So it's more than just having the conversation. It's really about impactful resolution to help you when now you're ready to talk to Wells Fargo and say, you know what, I want to open that credit card, or I want to get that mortgage, or I want to get that new car.
Oh wow. That's awesome. That's awesome. Martin, you want to chime in?
So everything that these guys said, on top of that, I would even take a step back. I think first step is to know what debt you have. So we know this is a made up scenario. I have 3 credit cards, I got student loans, I got this, I got that. But if you ask me how much the total is, I don't want to know. Right? There is some anxiety around that, and ignorance is bliss a little bit. Right?
Right.
So I think pulling your credit report, and you could do that through NFCC, or you can do it on your own as well for free.
Right.
Knowing what your full debt is, and that is a way to identify if there's any type of fraud involved, or something that you didn't open up. That's something else you can clean up as well.
Right.
But at the very least, know how much credit you have out right now. As painful as it might be to know that number, it's a great place to start.
Right. Exactly. Yeah. And also what happens is once you kind of know you're struggling in debt, it's almost like the trickle down theory. Sometimes you kind of bury yourself even deeper. He's like, I don't have the $2,000 to pay off this card, so let me go get my nails done.
Let me treat myself, right?
I'll get it, I'll work it out. And then before you know it, that 2,000 is 3,000. And the mound gets bigger and bigger and bigger and bigger. So it's awesome that you guys have these programs in place.
Asia, I know a lot of times I've heard people say, oh, I work hard, I deserve this,
Yes.
But then again, the numbers have to add up too. You have to be able to pay it off.
Right.
So it's not just about working hard, you deserve it. Well, you deserve also to be, not have anxiety around your finances either.
Yeah.
Right. Exactly. All right. So what's the best way to create a debt repayment plan? I'll start with you, Armand. What is your advice to someone with that?
Okay. That's a small question with a big answer. So, stick with me now. Stick with me.
Okay.
All right.
Let's go.
First, you want to take a look at and understand your situation. What kind of debt are you have? How deep in debt are you really?
Okay.
Now, I would suggest you list every debt you owe. That's credit cards, personal loans, auto loans, student loans, the whole kit and caboodle.
Right.
You want to include the balance, the minimum payment, the interest rate, and the due date for each. You want to also pull your credit report and check for any errors or issues that might be dragging down your credit score.
So when you say the due date for each, not the balance due total, but like just your monthly payment.
Your monthly payment, because you don't want to miss those. You don't miss those puppies.
Okay.
You want to review your income, your monthly income, and your expenses. Look at how much you bring in each month.
Okay.
How much has to go to cover your expenses, and after that, you are better able to determine how much you have left to realistically pay towards your debts. So having your financial picture, that's cool. Then you want to have your strategy and a budget. So in putting your strategy, there's 2 types that are most common. There's the debt snowfall, And what that is you pay off the smallest debts first while making minimum payments on the rest. And what that does is it helps you feel good and build momentum through quick wins.
Okay. Okay.
The alternative method is you want to look at the debt avalanche. So you want to prioritize paying off debts with the highest interest rates first. And what this does is this saves you the most money over the long term because you're getting rid of that expensive debt.
Okay.
The key thing here is in either case, you
Right.
want to create a budget that allocates a fixed amount each month toward debt repayment while still covering your necessary expenses.
Okay.
All right, we got more. We getting there. I promise you. It's a lot. Now, the important thing to know here is that as you're doing all this debt reduction, you still want to build your emergency fund.
Yeah.
Okay.
Because you always got to have an emergency fund. You don't want to be derailed from your debt repayment because you have an emergency.
Okay.
Okay, now we're going to bring it home. We're going to bring it home now. We turn in the corner. Wherever possible, ideally, you want to automate, monitor, and adjust as necessary. So automate your payments where possible. Set up auto pay because you don't want to rely on your memory or your willpower
Okay.
to make your payments. You want to track your progress,
Okay.
keep tabs on your debt balances, look at the interest that you save by making these payments, look at the number of accounts closed and improvements in your credit utilization. You want to overall just acknowledge your accomplishments and celebrate your success because this is going to keep you motivated through the repayment process. And if you look at your progress, it helps to maintain your motivation.
Yeah.
Okay. We have a question that came in. This young lady, her name is Nina. She said that she paid off all of her debt and she went to purchase a home 2 years later, and they said that she didn't have a strong enough credit score. So what's your advice to people who zero out their debt? Is that a factor when you're buying a home? Can you not zero it out?
Well, one of the things that Herman mentioned is making sure that you're monitoring your credit, right?
Okay.
And so, Nina did her part in, that's amazing, by the way, Nina, paying off all of that debt, right? But then you want to continue to monitor, right? So what Herman said was interesting because you're not doing it alone. When you're going through a debt repayment plan and you're working with a HUD certified housing counselor to go through everything, you're also learning while you're going through this.
Right.
So now you're conditioning yourself to operate with a budget, learning how to spend, learning how to save, learning how to manage. But you got to make sure that you're monitoring everything once the work is done, because the work's never really over, right?
Right.
You have to continue to keep that behavior moving forward. Martin and I, over the years, we run into a lot of scenarios where you have a homeowner they're ready to jump into homeownership, and they assume that they have a higher credit score than what's actually going to be evaluated by their lender.
Right.
And they neglected to check their credit report. And then once the lender pulled their credit, because the lender uses what's called the tri-merge system, where they're pulling scores from various credit reporting bureaus, right? And then they use that median score to identify your availability and your readiness.
Okay.
So if your score is lower, right, you have to understand that that's going to be a little bit more difficult for you to get into the product or the program that you're looking to get into. But if you're evaluating your score, you can say, well, I'm at 680 now and I don't have any debt. What steps can I take? Let me reach out to a professional. Matter of fact, the National Foundation for Credit Counseling helped me get through a debt repayment plan. Let me reach back out and say, okay, how do I build up my credit a little bit more now so I have more options? Right? You don't need an 800 credit score to get into homeownership, but you also need to show that you are able to manage credit in a large debt like a mortgage, because that is a 30-year commitment. And so monitoring is key. Never stop monitoring your score, even after you purchase, even if you're not purchasing anything. If you don't have any goals to purchase anything large in the future, continue to monitor that score. Understand how the credit reporting works. Understand that you may not need to close out every account, right? Even if you pay the balance down to zero, you may not need to close that card, right? Or if your utilization is really high, how do you manage that in a different way? Because there's different variables that credit reporting will show whether it's the utilization, whether it's the amount of accounts you had open, the age of the accounts. So there's a lot of different variables. Key point is to monitor your credit report as much as possible.
Right.
Wait, what's the word, Rulon?
What is the word?
Monitor. Oh, I'm just.
You said it for me. Monitor.
Yeah.
Monitor.
So, Age, I would say in Nina's example or question, my guess, of course, I don't know the whole story, is that yeah, she paid off credit cards or accounts and then closed them, which does impact your credit score.
Right.
So I think the easy answer is get professional assistance while you can.
Mhm.
Monitor, as Roland mentioned a few times there, and then yeah, and then you know your path to building up and maintaining your credit score.
So let me just add two things. Another variation of that is thin credit. People
Right.
who they didn't have a lot of credit, they have thin credit. And I guess I'm gonna use a really bad metaphor or whatever. Imagine you're a straight A student from kindergarten through 8th grade.
Right.
And you didn't go to high school. Now you want to go to college. Well, admissions, they're not going to let you in because we don't know how you can perform the last 4 years.
Right.
And that's what having thin credit is like. You got to keep having a good credit history up until the point where you want to get a house, for example.
Right.
That was a good analogy.
That was a
I
good
like that. That was a good one. That was a good one.
analogy. I like that one. Yeah, we need to see high school.
Yeah, give us high school.
I remember when I bought my home. I remember the guy that was walking me through the process. He said that credit is basically the ability to repay a debt. So they grade you on your ability to repay a debt. He said, so if you don't have any debt, how can we grade you?
Right.
It's your report card. It's your debt management report card.
Right.
That's what your credit report is.
I think people always kind of get that concept mixed up. They think if they have no credit, they have good credit, but it's two very different things.
Right.
Yeah, and sometimes that's just the way we were raised, right? You know, my father would always say, "Well, I don't want any debt," right?
Mm-hmm.
Right? And until it's time for him to have a track record of being able to manage debt.
Mm-hmm.
So there's a big difference because culturally, it's you know what, always pay with cash, right? Don't get into debt. Well, get a used car. Don't get a new car because why are you going into debt? So sometimes our ancestors, our parents, our grandparents, the people that we trust, you know, 20, 30 years ago, it may have been difficult for them to manage that credit piece. So they were paying everything in cash. And sometimes that information gets trickled down to us as we make our grown-up decisions as well, too. So sometimes that is the culture of how we were raised. So getting information like we share today, and as we've been sharing over our past few episodes, use that information to help guide your journey. Use that information to help guide your journey.
Yeah, we got to grow because all of us would probably still have money under our mattresses if we were listening to our grandparents.
I do.
Or buried in the backyard.
Yeah. And there's nothing wrong. There's nothing wrong with that. But make sure you're understanding the whole landscape.
Right.
Yep.
Exactly.
Right.
Exactly.
Understand everything. Mm-hmm.
Okay, so now that we're talking about debt and debt strategy, let's talk about tackling the debt strategically. You know, laying the groundwork for like mortgage readiness. So I'll start with you, Martin. What would be your advice? What are some of the most effective strategies for kind of reducing debt, and then how we kind of strategically lay the groundwork for mortgage readiness?
Yeah, so Herman started talking about this. So he mentioned the avalanche method, which is looking at getting your credit report, understanding what your all your debt is, and then start with the highest interest rate debt you have and start chipping away at that. Right. When I had student loans, luckily it's been several years now, I got rid of them. When I had that was tough. Unfortunately, any extra money I had went towards student loans, and that was a big number. And luckily I tackled it, but that's what I started off with. Look at the highest interest rate first, because sometimes student loans are divided up into, I had like 5 different smaller ones added into some big number. And look at the interest rate on that, tackle, then knock it off, and then, okay, what's next, right? And typically it's going to be a credit card that is a higher interest rate, especially department store credit cards seems to be higher. So I would start with that. And then also I would call nfcc.org as well. To get assistance.
Exactly.
We are receiving.
Yeah.
And sometimes we don't even know what those interest rates are, right? I remember when I was
Yeah.
doing finance, one of my cards had gone from like 23 to 39%. I
They
had
will
no
hurt your
idea.
feelings. They will hurt your little
Oh my
feelings.
gosh. I was like, what? And I'm just charging away. I was like, no, throw that card in the trash. Like,
I remember I was paying one, and I'm like, I was paying a good chunk of change. I'm like, I don't
yeah.
seem to be making any
And
progress.
he
I
didn't.
looked
Yeah.
at it, 38%. I was like, oh
What?
my word. It took my breath away. It took my
Well,
breath away.
Right. Right. And another
And my money.
that part. And another thing that creeps up on you too that you need to check out are your the yearly fees.
oh yeah.
You
The
know,
credit card annual fees. Yeah.
so with a recent credit card that I had, my Amex went
APRs
from
and all that
$6.95 to $8.95 a year. And you're like,
Wow.
do I want to pay that?
No.
I'm probably gonna, because it's a great card, but yikes, you know what I'm saying? Like some of
Just
those.
pay it off. Just keep small balances and pay it off so you
Mhm.
don't have to pay the interest rate. So you still get the points or the benefits that they're offering, but you're not paying that ridiculous interest expense.
Right.
But you're paying a month. You're saying a yearly fee though, Asia,
The
right?
annual fee, like people don't
Yeah.
Oh,
know
okay, yeah,
annual
well,
fees
yeah.
too, because they'll tack that to your balance.
You getting
Yeah.
access to airport lounges, Asia? Is that what it is? Yeah.
Don't tell me.
Yeah. But life happens though, right? So
Yeah.
sometimes life will life, right? And you,
Right.
you got to make a quick decision. Hopefully this information we're sharing today allows folks to read that fine print, to understand,
Yeah.
if it says the first 6 months interest free, like what does that mean after a year is over, right?
Right.
So understanding it and being able to manage it. So the knowledge is extremely important because sometimes we're in a jam and
Right.
we might have to put something on a credit card or we might not be able to pay the student loan bill this month, right?
Right.
So we have
Right.
to find a way to rob Peter to pay Paul. And
Mhm.
unfortunately, that behavior sometimes becomes repetitive, right? Until we get the right type of advice, we continue to make those decisions. And now, when it comes down to us wanting to make that big purchase,
Right.
there's a lot that comes into it because it's not
Right.
only your credit, but your ability to save as well, too, right? For a down payment or to cover your closing costs. So all of that stuff has to be in lockstep. So
Mhm.
to Martin's point, like just thinking about the different strategies and understanding what they are will help you understand what your level of comfort will be when you adopt one.
Absolutely.
You can.
And so we talk about.
I
Go
got
ahead.
one thing. I got one
Go
thing,
ahead.
and I'll be quiet. I promise. We talked about when you have multiple obligations that you have to pay off.
Yes.
As soon as you eliminate one, all freed up money should go into paying the rest
Right.
off. Don't use it to then buy new stuff. No, use it to help accelerate your debt reduction strategy. I just want to get that out.
Yeah. So we're talking about checking our credit score. You mentioned, Rulon, that you have to look at your credit score. Why is that important for someone that's starting out with their home ownership or their process, the first time home buying process?
Yeah, it gives you access to so many more options when your credit score is a bit higher, when you're managing your debt, when you understand your finances. Looking at your score, that's understanding your financial situation, right?
Mm-hmm.
So if you're not looking at your score, you know you're budgeting, right? But if you're budgeting and you don't know what your score is, that becomes counterproductive, right?
Right.
Or so if you just know your score, but you're not budgeting, so they have to go hand in hand. So when you think about your credit, I mentioned the monitoring piece, understanding what the score means, and also doing research on what a score will get you, right? Right. So there is this myth that we've heard for years that you need a 780 or 800 credit score in order to get a mortgage.
Mm-hmm.
That isn't true. There's programs out there, there's products out there that allow you to get a mortgage if you're in the high sixes, right? Obviously, you have more opportunity if your credit score is a bit higher. But how are you monitoring your credit report? Because it's not just about the score, right? It's about the liabilities within your credit report, right? Martin told a story a few episodes back around having something on his credit that he just wasn't aware of, right?
Right.
And so being able to understand what creditors that you have, how much you owe, and your score will allow you to have a deeper conversation when you're looking to shop or explore, whether it's let's just use something smaller, whether it's opening another credit card or getting a new car. But that mortgage, that's a 30-year commitment. So that's a really a larger process. So understanding how to take care of your credit score just allows you to have more financial freedom, more options. And also you become a more attractive consumer to
Right.
banks when your score is higher, right? They're going to throw more options your way just because you have the ability to do so based upon your credit score and your credit worthiness.
Okay.
Yeah.
So, Herman, this question is for you. We're going to go back to Nina with her not having a high enough score, having thin credit, if you will. How
Mhm.
can someone improve their credit score?
Well, what you want to do is you want to look at your payment history and pay on time every time.
Okay.
You want to make sure that when you pay, you're paying at least the minimum payment.
Okay.
You want to not take on any new debt
Right.
because you want to affect what's called your credit utilization. Your credit utilization is how much credit you are allowed versus how much you're actually taking.
Okay.
And a lot of folk look at that really curiously because unfortunately some people need to use their credit to subsidize their income to manage their lifestyle.
Mm-hmm.
And if you have, say you have, for easy numbers, you're allowed to borrow $100, but you're just using $10 of it, that's a 10% utilization rate. That means you're really good.
Right.
But if you're allowed $100 and you're at $98, 98, 99, 50, that means you get white knuckle holding on.
99.
99. You are one financial shock from what happened?
That's right.
So these are different ways that managing your debt, paying on time, paying at least the minimum, and reducing the debt, but not closing. Don't close your credit card accounts.
Okay.
Don't open any new ones, and definitely don't open a bunch of new ones in quick succession because that's multiple hard pulls, and that's going to reduce your credit score.
Okay. Should you pay them off in like a Nina situation? Should you leave like something? Just pay it down?
No, you can pay them off. Just use them. You can pay them off, but keep using them and paying on time.
Okay.
That means you're managing your credit responsibly.
Okay.
And that's going to help your score go up.
Okay.
Good point.
So that leads me to my next question. So how much credit utilization is too high? Do we use that DT or debt to income? Do we use that kind of as a scale to find out how much we use when people talk about DTI? Or you let me know how much is too much credit utilization?
Well, so I'll say, so Herman, that example was perfect. That's a great example of kind of how to view it, right? Because you're using a whole number and then you're essentially using the majority of that, which puts you in a financial constraint. Because to Herman's point, one issue that arises in your life and now you are over capacity, right? So that makes it really difficult. When you think about debt to income, that's a bigger equation.
Okay.
Because now we're looking at how much money you make versus how much money you have to pay each month. And then that allows a mortgage company to determine what's affordable for you.
Right.
Your credit score does play a part in that, right? Because essentially those liabilities on your credit report, those are something that are obligated in your debt. So we do that calculation. So for example, if you're doing a financial worksheet where you're looking at how much money you spend and how much money you make, that financial worksheet could include how much food you buy, television, cell phone bill, but it's also going to include your credit cards, right? And your other obligations. If your utilization is low, that's meaning that you're managing that debt differently. Now, your payments each month may not change, even if your utilization is low. So based upon Herman's example, even if you're using 10% of the utilization, but your monthly payment is $200, you're still paying $200. So that still goes a part of your monthly debt. Hopefully you pay that off and it's zero. So that way it does impact your debt to income because you have less debt, right? So there are two different calculations, but you're on the right track if you're keeping a low utilization because it will reflect in your overall debt and that being a bit lower.
Okay. If you're just joining us, you are watching Paving the Way Forward, presented by Wells Fargo and NFCC, the National Foundation for Credit Counseling. This is an amazing platform for you to learn more about the home buying process. And so if you need more information, please visit wellsfargo.com/mortgage education, or for a better life beyond debt, visit nfcc.org. And we would like you to take a look at this.
When finding a home, every step matters. Wells Fargo is here to guide you with free resources at wellsfargo.com/mortgage education. Learn what to expect at every step. No jargon, just clear, helpful advice. Our free online tools will help you get started on your homeownership journey. This message is in collaboration between Wells Fargo and the National Foundation for Credit Counseling.
Terms apply.
Martin, so smooth.
Here we go.
He looks familiar.
Here we go. Who is that guy? Right.
That's the left coast representing the left coast. Oh my word.
I love it. I love it. All right, so we're going to continue this conversation. People are chiming in. We're talking about protecting and rebuilding credit. Good subject, by the way. We mentioned earlier that we should check our credit. How often should we do that?
That's a good question. So I'll give you a few scenarios. I have a buddy who checks his credit every other day.
Why?
He's
Obsessed.
In his mind, it's like, so I give you the backstory. And, you know, I love my brother. So he doesn't mind me sharing this, right? So I have a really close friend, and a few years ago, he had a very low credit score, right?
Okay.
And he was renting, and he had a job where he would travel a ton. So the only thing he really needed to worry about was paying his rent and then paying a few credit cards here and there. So he wasn't really monitoring his credit. So fast forward a few years, finds his lovely wife, they have a child, and now he's like, you know what, I'm going to settle down. So now it's time for him to get a mortgage and a bigger car. So he needs to upgrade his house, his living situation, and his vehicle, right? Because now it's, instead of one person, it's three.
Right.
So he goes to get an auto loan, and they tell him that his credit score is extremely low, but they could still get him a loan, but his interest rate's higher.
Right.
He's like, well, I got to do it. I got a newborn. I'll go ahead and get this SUV. And my interest rate at that point was 11%, right? So he had a higher interest rate. So now he's paying on it, but he's still actively searching for a home, but he's not checking his credit score at all. So now when it's time to get this home, his first step is, you know what? I'm going to go talk to my lender. I hear that they have really low interest rates, and I hear they have a program coming out. Let me go have a conversation with them. They pull his credit is 580.
Oh.
So they say, you know what? With this credit score, right? There's no way that we can get you into a mortgage at this moment. So he actually works with a housing counseling agency that's local here in Florida, and he's able to get his credit score back up to the high sixes, low sevens.
Okay.
And that gave them the ability to get that home that they were looking for. But one of the things that he learned from working with the housing counseling agency is to check your credit, sign up for the free credit reports, and then just make sure you're monitoring it once a month. Well, I love him, but he's a little off. So instead of once a month, right, he's checking it every other day. Right? Oh, I love him. But he's checking it every other day.
About me?
But now his credit score is 775. Right? So he's checking that every day. Now that's a little over the top, right?
Yeah.
But he's checking it every day. The adverse to that is that you might have scenarios where you're not checking your credit often enough, and you're just not sure of where you are financially. And then when you go to make that big purchase or that big decision, you hear that no or that not now, and you scramble to try to solve your credit problem on your own. So that's when it becomes extremely, extremely important for you to work with someone like the National Foundation for Credit Counseling and help getting everything in order, understanding how you can manage your credit, understanding what the score is, monitoring it, so on and so forth.
Right.
So if I could, your credit score, we talk about it largely in the midst of this program as it relates to buying a house, but your credit score affects your everyday living. A good credit score helps you borrow money more easily, as Rulon was talking about, whether that's a mortgage, a car loan, or a personal loan. Lenders use your score to assess risk. Are you a risk-worthy investment? And it often a lower interest rate, a higher credit score lowers your interest rate, gives you better loan terms, which translates into literally tens of thousands of dollars over time that you save. Your credit score also affects those aspects of your life, like that go beyond borrowing, for like rental housing options, security deposits for utilities, insurance rates. There's certain jobs you can't get
Okay.
If you have a low credit score, so for example, imagine the individual who goes to college for 4 years, takes all those loans, invests all that money in their future, comes out, makes some bad decisions. Now their credit score is cratered. They graduate, and the very job that they spent 4 years preparing for, taking those loans out for, they can't take because they have a low credit score. So it goes beyond housing. It affects your life.
That's right.
That's true. That's true. I remember many years ago, I needed a large sum of money right away. And I went to the bank and I had on a hoodie and some jeans, and they looked at me like I was crazy. Like, what do you want? But I sat there and I filled out the application. Now, this is when you use paper now. And they pulled my credit. My credit was strong because they came right back and they were like, Miss Chandler, what do you need? What do you And they gave me what's called right. And they gave me what's called a signature loan, which they don't do anymore.
Yeah.
But I was so impressed. That's when I realized just how important good credit was, because I was able just to walk in and I picked up my check like the next day. Is that crazy? They don't do it anymore.
Yeah.
That was a good feeling, I gotta tell you.
Well, I want to know, Rulon, your buddy's watching and say, "Oh man, is he talking about me?" Or you know,
he's a success story.
Yeah.
He's a success story, right?
Oh,
So
okay.
his OCD allowed him to increase his credit score. Not saying everyone should check it every other day,
No,
right?
but check it. Right.
Well,
He's not going to be surprised. That's for sure.
Every other day is excessive. Yeah, that's too much, probably. But for sure, it is too much. But I would say if you're a Wells Fargo customer, and I know with other banks and you're with other credit cards as well. For example, Wells Fargo, the app, you can check your credit score for free. I think it updates once a month. And as I mentioned, other banks and other credit card apps do the same thing. So that's just an easy way to kind of just, oh, there it is. It can't come through once a month. Oh, there it is. All right. Nothing excessive, right?
Just
But just know about it. Yeah.
Absolutely. So if you see something, Martin, on your credit, how can you kind of dispute those errors?
Well, that's I mentioned this before. This example before it happened to me, where it was a cable company in Las Vegas, and I don't live in Las Vegas. I never lived in Las Vegas. Said I took out DirecTV and didn't pay it for some ridiculous 6 months or something like that, 6 to 12 months.
Okay.
And thousands of dollars later, sitting in my credit report. Well, the good thing is, if you pull your credit report on a regular basis, you could see that. I didn't. Well, at the time, I wasn't doing it every other day, right? But I wasn't doing it enough. But luckily, I caught it before I really needed my credit score for something good. And within the credit report, there's a button you can push to dispute it.
Okay.
Takes a few weeks sometimes, but it's pretty straightforward. And you may have to, do it depending on how big it is, and if it's fraud, you may have to do a police report. You may need to, or something small. It's something straightforward, but nevertheless, you can get that cleared up. It's simply after a few weeks, once you clear it, it simply goes away, and magically your FICO score goes up. So it's wonderful, but you need to know what is going on. And one indication of that is your FICO score. If it starts going down, then you got to say, okay, why is it going down? Let me pull my credit report. Now I got all the details, see what happened. I even had a scenario also where a credit card company, this is years ago, reported that I had a credit card late 2 years before. And I know I pay everything on time. So I went back and said, hey, this is wrong. I called the bank directly. I still had that credit card open, and they cleared it up. And the next time my credit report was pulled, it was cleared. So pretty straightforward.
Okay.
I would add that, you want to go to the 3 major credit bureaus, Equifax, Experian, TransUnion. Always review your reports for errors. Like Martin said, look for things, accounts that aren't yours. Identify any wrong balances, incorrect payment status, or incorrect personal information. And if you identify something, gather the documentation that supports your case. For example, any receipts or anything like that, and identify that proof to the reporting agency, the agency that has the wrong information, as well as the vendor that reported that wrong information. Let them know that, hey, I ain't your guy. And just check. They have about 30 days to correct it.
Okay.
and just make sure they correct it. But just keep at that point, you might want to turn into almost Rulon's boy.
Right.
Not every other day, maybe every other week.
Guys, a little bit off.
Almost
Yeah.
Rulon's boy. And
So
then check that one.
I would say this. It's so it's so funny.
Want to do a shout out, Roland? You want to do a shout out?
No, I am
Okay.
not going to put him on Front Street. I think he gets an indication who he is. If you watch. So don't be afraid to ask the questions. Don't be afraid to inquire. Use Martin's example. Hey, I don't know what this is. Right? What is this? Right? Take control of your financial future. A lot of us, especially when we're starting to learn a bit more around our finances, we assume that the credit score is this overarching number that grades our life, our behavior, the type of person we are. It's like a social score sometimes.
Yes.
You're managing that number by your behavior, right? So don't be afraid to say, you know what? I don't feel like that number is accurate. Let me check my score.
Right.
And then if you see something there, like an account in Las Vegas, right? Or something like, I've never used this. So take control of your financial situation, and don't be afraid to call and say, hey, I don't know what this is. Don't be afraid to hit that button to dispute that inquiry on your credit report, and take control of your financial situation.
Okay.
Now,
Now
I have a question for Herman, actually. So, Herman, you mentioned
Where is he? Where is he?
You mentioned pulling 3 credit bureau credit reports, right?
Mhm.
Does it ever happen where, say, 2 of the 3 are correct, but that one is 2 are reporting correctly, but the third one is not? Is that ever
that happens? That happens. Yep.
Yeah.
And you want to let them know, hey, look here, okay, fix it. The other 2 got it right. You need to get it right too.
Yeah, and that does impact your overall score when you're having those bigger purchases, because as a bank, if we're your lender and we're pulling a thing called a tri-merge, and that's all 3, and that's a combined score. So if you're doing the math and one is incrementally lower, then that's going to knock off your overall average. So Martin, to your point, like you got to make sure that you understand what those numbers are, so that way you can get the best outcome.
Absolutely. So, we all kind of went through it recently under our, in this country, kind of going through the government shutdown and things like that. So when people kind of experience these like financial hardships, whether they're long-term or temporary, how can one rebuild their credit after something like that? Anybody?
I have a plug. It's this place. It's called the National Foundation for Credit Counseling. In a time of crisis, go visit them, nfcc.org. As a financial institution, we have the ability to assist when there is a hardship if you're unable to pay on your debt, whether that's your mortgage, whether that's your auto loan, whether that's your credit card. But ultimately, there may be some other factors at play, right, that show up by you not being able to pay those debts.
Okay.
Go to a financial advisor in the form of a housing counselor or a credit counselor and allow them to assist, right? That's not going to be an extra expense to go there. It's a free service. And then also they're going to help you along that journey. So whether it's repair after a hardship, once you get that corrected and you're looking to re-enter homeownership or re-enter back into another credit card or auto loan, when you're back on the right track, they can help you even further when it comes down to what you're able to receive or get after you repair your credit. So sometimes from a bank's perspective, it's really hard to change the behavior or the outcomes that are out of the consumer's control, right?
Mm-hmm.
Someone losing their job, that's really difficult. And sometimes it's out of everyone's control, but that obligation still needs to be met.
Mm-hmm.
Go to a trusted advisor. I always give that plug to the National Foundation for Credit Counseling because they are amazing and they service across the country. So no matter where you are, you don't have to meet with anyone in person. You can call in on the telephone number. You can visit their website. They're a really good resource to really help if you're in a financial hardship.
Thank you.
I love that.
Yeah.
Thank you.
I'll break it down like this. If we have a hardship, and sometimes it's limited to what you can do, but when you can, you want to bring all your payments current, and you want to make sure any past due accounts are brought up to date if possible.
Right.
This may include setting up payment plans or negotiating with creditors, but just let them know, here's my situation. I want to make good on it. I'll work with you if you work with me. Now they may freeze your credit while you're doing that, but they still know you're working with them.
Okay.
When you can, you want to pay all bills on time every time, because your payment history is one of the most influential factors in your credit score. And a good rule of thumb is you want to pay on time. Paying on time means when you pay, it gets there by the due date, not paying on the due date.
There.
Then you also want to keep your credit balances low, because you don't want to have an issue. Again, you're rebuilding. You want to consider credit building tools like a secured credit card, where you pay the money up front, and the money you spend is the money that you paid up front. So that way you're covered.
Mm-hmm.
And you always, as we've been talking about, you always want to monitor your credit reports and fix any errors. So that would be the plan, I would say. And that's often the plan that we use when you're dealing with a counselor.
Absolutely. I love that. If you're just joining us, you are watching Paving the Way Forward. I'm your host, Asia, with Urban One. It's presented by Wells Fargo and the NFCC, National Foundation for Credit Counseling. Today, we're here to empower you to monitor, protect, and restore your credit as part of the home buying process. And we'd like you to watch this message.
Buying a home is exciting, but understanding your mortgage options can feel overwhelming. At Wells Fargo, we're here to simplify the process. Our free online tools at wellsfargo.com/mortgage education can help you learn more about the components of your mortgage, your credit score, and what works best for your budget. Take control of your home buying journey with resources you can trust. This message is a collaboration between Wells Fargo and the National Foundation for Credit Counseling.
It should be illegal. He's so smooth.
Oh, is that the guy that talked about his
It
friend's
should be
credit score?
illegal.
Listen, a lot of people are chiming in. A lot of people are excited about the conversation. We want you all to continue to stay motivated. We want you to continue to plan ahead. And so we're going to keep and jump right back into the conversation. And I'll start with this. How important is an emergency fund when you are paying off your debt? So we talk about getting our finances in order, paying that debt down, but we have emergencies, right? I was sharing with you guys that my pipe broke. Sometimes stuff happens. So how important is that?
It's so important that you cannot afford to ignore it. Yes, you're paying down your debt, but you don't want an emergency to pop up and derail all the progress, all the success you've made in reducing your debt. So don't ignore the emergency fund, even when you're paying back your debt, because you worked hard. Now, to be fair to yourself, if you're in debt, chances are you didn't get there overnight. And so you got to be realistic. You're not going to get out of it overnight. So you got to have a plan. And part of the plan is also funding that emergency fund.
Okay.
Because life comes at you fast and busts you right in the face.
Right.
And I think it's important to note that emergency funds are truly just for emergencies. It's not to pay off your debt. It is the broken sewer pipe, the broken,
transmission going,
water heater, whatever, something going wrong, accident, whatever, but not to pay your everyday going out to eat. Oh, I want to go out and get a nice meal. Nope, that's not an emergency.
There you go.
Okay.
That's right.
Even if you're having a bad day? No, I'm just playing.
Not an emergency.
The Starbucks fund, right?
Start your own bad day fund. Yeah.
There you go. There you go.
And that leads me to my next question is like, how can I stay motivated to stick to my budget? And like, we know life is always life, and you can have that bad day. Your boss could just kind of do something, or you get a flat tire, or you have a bad breakup. It's like, sometimes you just want a nice lobster dinner and a glass of wine. But so how can we stay motivated to stay within our budget?
So that's a great question. I look at it in two ways. Sometimes you're forced to be motivated, right? Life will push you to say, all right, I need to make this change and stick with this budget because I don't have a choice.
Right.
But then sometimes it's the aspirations of buying a home or purchasing a new car or just having financial freedom to be able to go on a trip, right? And so you have to find what motivates you. Sometimes that motivation can come from different places. It could come from having a loss of income in the household, right? So it could be trauma that creates the motivation.
Right.
Or it could be, you know what, I've been renting for the last few years. Price of rent is going up.
Mhm.
and there's this home that I've been looking at, and it's a bit cheaper for me to be a homeowner. So I need to save. Let me stick to my budget. Let me view my credit score. Let me understand my finances so that way I'm motivated enough to buy. Right. So motivation can come in different forms, but once you start to have that behavioral change around
Mhm.
your budget,
Mhm.
things start to be a bit easier on how you're able to remain motivated when it
Right.
comes down to saving. Because once you're taught how to fish, you're going to be able to go out to that lake and cast that reel, right? So
Right.
just being able to remain motivated, it's really a behavioral change. And we talked about this a lot with the National Foundation for Credit Counseling, what they provide as a counseling service. It's really giving you a deep dive into your financial journey and helping you understand how to navigate. And so motivation can come from different ways, but really the goal is to try to make sure that your behavior is in the right place so that way you can manage your finances appropriately.
Right. And you said that it's a little cheaper when you own a home. It's like a lot cheaper.
There
Even
you go.
on my
Yeah.
street, like a few houses down, the rent on that house is double my mortgage.
Yeah.
So
Yeah.
yeah, the
And
rental
Asia,
market is
you can't
vicious.
control it. You
Right.
can't
Yeah.
control, that's a benefit of home ownership, right? So you
Mhm.
understand what you'll be paying. You might have some variables as far as,
Mhm.
if your mortgage is escrowed and you have your homeowner's insurance, it might go up a bit, or your property taxes might change year over year. But for all intents and purposes, you understand how much you're paying.
Right.
This rental environment is very volatile, right? So
Right.
depending on where you live, if you're in some of our larger metropolitan markets, you're going to see that fluctuate. And then now, if your family's expanding and you have to go from a 2 bedroom to a 3 bedroom, now that price is really going to go up. Or if you're changing school districts, right? So there's a lot of variables, but rent is so high at the moment. So
Yeah.
home ownership isn't a bad choice today.
Right. Right.
So one thing that motivates me is power.
Mm.
And another word for power is control. When you have a budget, that is your financial plan for where you are to where you want to get to your dreams. There's a lot of power in having that type of control, of understanding what you can do and determining what you should do under various situations. But having the finances, I was just talking to my wife today. We were talking about we had a medical procedure, and
Mhm.
we look, given the circumstances in society today, the cost of Medicare, people would not be able to do what we were able to do today because of finances. So we had control, we had power to ensure our health stays stable. So a budget, being financially solvent, understanding the power of managing, investing, and home ownership, all that plays into a better, brighter future. So I'm motivated by power, especially when that power is mine.
Right. Makes sense. It makes a lot of sense. We had a question come in from Brian. He says that he heard that mortgages now have 50-year mortgages. Is that advisable? 50 years.
Mark,
That's just conversation right now. There's nothing behind it yet.
Okay.
But is it advisable? I wouldn't do it. For myself, I think it depends on your situation.
yeah.
Do you want to be paying at a later age in life? I would not want to, but sometimes it may work for some individuals in their scenario. So it depends. I think there's still a lot more to learn about it since it's not official yet.
Mm-hmm. Mm-hmm.
It's just hit some headlines. I think it was on social media recently.
Yeah.
Yeah.
Yeah. Yeah.
Is
And
this
over
is
the
it just a rumor or is it really gonna happen?
well,
Not a rumor. I think the president mentioned it. I think that's where it came from. I think he's urging Fannie and Freddie to create that, but is it going to happen? I don't know.
yeah, and one of the I mean, it's a suggested solution to our current housing crisis because of the affordability, right? So home values are high
Mm-hmm.
and supply is low. So when you think about someone getting into home ownership, that cost increases along with what they would have to pay out of pocket to get into to said home. So down payment, closing costs. But over the years, 34 years ago, we didn't have 30-year mortgages, right?
Right.
And so that change was a subtle increase as well too. But when you think about 50 years is a long time. So think about
Yeah.
the interest that accumulates,
Right.
right? because the first half of your mortgage is interest heavy.
Right.
The back half is principal heavy. So you'll be paying more years in interest with a longer mortgage term.
Right.
The strategy would be to make additional principal payments as you're making those interest payments. Pay more on the interest, on the principal.
And that's for any mortgage term, right?
Yeah,
That's the solution for any mortgage. Yeah, exactly.
That
So
reduces.
it was originally 15 years, right?
There's yeah, you could do 15, 20, 30, and then usually 30. There's conversation 40, and then some may have 40, I think, out there.
Yeah, but that was a COVID reaction. That was more or less a change during COVID times where the conversation of having a 40-year mortgage was expanded. But now even today, if you're looking to get a mortgage, you can still get a 15-year mortage, right? You can still get a shorter termed mortgage.
Get a 10-year mortgage with Wells
You
Fargo.
get yeah. Oh, there you go.
Balling out of control.
Yeah.
Asia, I would say the reason why I would say it does not work for me is because when I retire, handful of years from now, I don't want to have a mortgage anymore. I want to be able to focus on my expenses, just basic living expenses, and not have something hanging over me until my death, essentially. So
I want my pina colada fund.
Yeah.
Right.
Yeah. The average age of homeownership right now is in the high 40s, late 50s, with people starting homeownership or buying homes.
Really?
Right. So the thought is that, first time home buyers, that number is low, but people that are entering homeownership, not saying it's their first time, but they're purchasing, that age is a bit higher. So now imagine someone that's 45 that's getting a 50-year mortgage. It's an interesting concept. Mm-hmm.
I did not know that the average age was in your 40s.
Yeah, it's up there. It's up there. Yeah, those are the folks that are buying homes. That may not be your first home, but that's the median average age of people that are purchasing today. You're going to have your 25-year-olds that are, but think about that age. Those are people that are financially stable, that have been working for years, and maybe they're looking to enhance or upgrade their living situation. So they're the ones purchasing in the market. Mm-hmm. And so now when they get that new mortgage, is a 50-year mortgage their option? Who knows?
Yeah. Who knows? Okay. As always, this hour always flies by when I'm with you guys because I learn so much, and I'm sure all of our viewers, they learn just as much as I do. We just have a good time, and it's a great time for a great cause because we are out here again, changing lives, and that's an amazing thing to have this conversation and for it to really help someone in their life. So when we think about this conversation today, what do you want our viewers to take away? And I'll start with you, Harmon, first. What would you like them to take away from our conversation today?
I would just say it's okay to dream. Make sure you budget to achieve that dream. Don't let anything derail you. You may be in debt now, but the budget helps you overcome debt and provides the pathway to the attainment of your dream. So, and always have an emergency fund.
Okay. Martin, same question. What would you like them to take away?
I would say I know perhaps some things we try to simplify things and make things straightforward, but we also know that sometimes this could be overwhelming, and that's okay. So the good news is you have nfcc.org, National Foundation for Credit Counseling, as a fantastic resource to walk you through it and to get you on the path to homeownership if that's the goal you'd like to have.
I love it. And Rulon, what would you like our viewers to take away today?
I hope you enjoyed this session. We'll be back next month. We aren't going anywhere, and we're bringing you some good information every time we meet.
That's true. I love that. That's a wrap, guys, if you can believe it.
Spread the word. Spread the word.
Spread the word. Listen, text a friend, tell a friend, let them know to definitely watch the next episode of Paving the Way Forward. We hope that today's Q&A, again, was able to answer some of your questions. And if you weren't able to get your questions answered today, feel free just to inbox us or drop those questions at any time, and we will try to answer them in our next conversation. To learn more about the home buying process, visit wellsfargo.com/mortgage education. And for a better life beyond debt, visit nfcc.org. I'm always so pleased and honored to be your host. Again, I'm Asia with Urban One. You can follow me at Always Ask Asia on Facebook, Instagram, Twitter, and TikTok. Again, that's Always Ask Asia. And before we go, we close our conversation. We thank you so much for watching, and we leave you with this.
Buying a home is a major milestone, but it starts long before the search begins. Understanding your credit, managing your debt, and setting a realistic budget are key parts of the journey. That's where credit counseling comes in. Through the National Foundation for Credit Counseling, certified nonprofit counselors provide personalized support to help you take control of your finances and prepare for responsible homeownership. There's no pressure, no hidden costs, just trusted guidance. You'll learn how lenders view your credit, what you can afford, and how to improve your financial profile so when you're ready to buy, you're truly ready. Before you find the right home, find the right path. Start with the National Foundation for Credit Counseling.